The $548,000 inheritance tax trap hiding inside your IRA and how to disarm it before you die. Picture this scenario for exactly 60 seconds. A woman named Margaret, 68 years old, lives in a paid-off ranch house in suburban Ohio. Worked for 41 years as a regional manager for a logistics company. Never took fancy vacations. Drove the same car for 16 years. She did everything financial experts told her to do. Maxed out the 401k every year. Never touched it early. Deferred, deferred, deferred. Let it compound in peace. The financial planner at the bank lobby looked her dead in the face in 1998 and said those magic words. "This is the eighth wonder of the world. Tax-deferred compounding. You'll be a millionaire by retirement." He was right. She did it. She has $1.1 million in that traditional IRA right now. She has another $180,000 in a tax-deferred annuity she bought in 2009 when the market crash terrified her. And she has a 403B from teaching adjunct night classes that holds another $94,000. All told, Margaret is sitting on roughly $1.37 million in pre-tax retirement accounts. She looks at that statement every quarter and smiles. Because in her mind, that money isn't hers anymore. That money belongs to her son David. That money belongs to her daughter Rebecca. That money is her 3 grandchildren's college tuition fund. That is her legacy. That represents 41 years of skipped vacations, packed lunches, and clipped coupons, crystallized into one beautiful financial monument. Here's the part they never told her. That $1.37 million is not actually $1.37 million. That number on the statement is a lie. It's a gross figure, a pre-tax illusion, a fantasy number that exists only on paper. Because the second Margaret takes her last breath, the Internal Revenue Service walks into the funeral home, sits down in the front pew, opens up a leather-bound ledger, and starts calculating their cut. And under the rules they wrote in December 2019, signed into law as the Secure Act, and then reinforced with Secure 2.0 in 2022, the IRS is not going to wait 30 or 40 years to collect their money the way they used to. They are going to demand it inside of 10 calendar years. And they're going to demand it during the exact decade when Margaret's son, David, age 44, is at the apex of his earning power as a hospital administrator, pulling down $168,000 a year. They're going to demand it during the exact decade when Margaret's daughter, Rebecca, age 41, is married to a software engineer with a combined household income cresting $290,000. You see what just happened? The IRS just engineered a tax collision. They took Margaret's retirement money, which was sitting nicely in a 12% effective tax bracket while she was alive, and they catapulted it into the 32%, 35%, and in some cases 37% federal marginal tax brackets of her adult children in their peak earning years. They added state tax on top. Ohio takes another bite. If David moves to California for that promotion, California takes a 9.3% bite. If Rebecca's husband accepts that New York City job offer, New York takes a municipal bite on top of the state bite. By the time the dust settles on this so-called inheritance, Margaret's children are going to keep roughly 60 cents on every dollar of the money she worked 41 years to accumulate. The IRS, the state tax agencies, and a buffet of local jurisdictions are going to walk away with the other 40 cents. Approximately $548,000 of Margaret's life work vaporized into thin air, wired directly to government agencies to pay for programs Margaret never voted for and services her family will never receive. This should make you absolutely furious. And if you are reading this right now and you have a traditional IRA, a 401k you rolled into an IRA, a SEP IRA, a simple IRA, a 403B, or a non-qualified annuity, you need to understand something critical right now. You are Margaret. Statistically, demographically, behaviorally, you followed the exact same script. You are Margaret. You followed the same advice the advisor sold you in 1985 or 1992 or 2003. You deferred income. You let it compound. You bragged about your balance at Thanksgiving dinner. And nobody, not your CPA, not your broker, not the talking heads on the morning financial shows, has sat you down and shown you the mathematical guillotine that Washington built specifically for accounts exactly like yours. So we're going to do it right now. We are going to walk through line by line, calculator in hand, exactly how the Secure Act 10-year rule turns your tax-deferred nest egg into a federally subsidized wealth extraction device. We are going to identify the 3 specific account types you must begin draining before you pass away, or you are essentially writing a check to the IRS for 40 cents on every dollar of legacy you thought you were leaving. And we are going to map out the surgical, perfectly legal, completely IRS-sanctioned strategy your accountant should have given you 10 years ago, and probably didn't because, frankly, it generates them 0 billable hours and requires actual work. Before we go one word further, understand this is not legal advice. This is not tax advice. This is not investment advice. Nothing you read here should be construed as professional guidance for your specific situation. This is educational information based on current tax law and publicly available information from the Internal Revenue Service and congressional legislation. You must consult with a qualified tax professional, certified public accountant, or licensed fiduciary financial advisor before making any decisions about your retirement accounts, tax strategy, or estate plans. Every person's situation is unique, and what works for one retiree may be completely inappropriate for another. Now, let's talk about the evidence. The first thing you need to understand is what died. The corpse on the floor is called the stretch IRA. For roughly 20 years, from the late 1990s through the end of 2019, the rule said this: if Margaret died and left her $1.1 million IRA to her son David, David could stretch the required minimum distributions from that inherited account across his own life expectancy. The IRS used to publish a single life expectancy table. David, in his 40s, would have a life expectancy factor of roughly 40 years. That meant David would be required to withdraw about 1/40th of the account balance each year. On a $1.1 million account, that's $27,500 in year 1. A manageable trickle, a controlled flow. Most of that distribution layered onto David's existing income might bump him up half a tax bracket and cost him maybe $7,000 in federal tax that year. Painful, yes, but survivable. And the remaining 96% of the account stayed inside the IRA wrapper, growing tax-deferred, compounding for the next 4 decades. By the time David hit his 80s, that original $1.1 million inheritance might have grown to $4 or $5 million. And across his entire lifetime, his cumulative tax hit might have been 30% total, spread so thin across so many years he barely felt the individual cuts. That was the Holy Grail. That was the entire point of leaving an IRA to your children. The stretch provision, the slow drip, the generational wealth building machine that let one generation's savings multiply across the next generation's lifetime. Washington looked at that machine in 2019, and they did not like what they saw. They saw too much liquid wealth flowing untouched from one generation to the next. They saw a tax base they could not access for decades. They saw money compounding outside their immediate reach. So they killed it. The Secure Act of December 2019 took a sledgehammer to the stretch IRA provisions for what the IRS classifies as non-eligible designated beneficiaries. That's bureaucratic language for your adult children who are not disabled, not chronically ill, and not within 10 years of your age. In other words, almost every adult child of almost every retiree reading this right now falls into that category. The new rule is brutal in its simplicity. The entire inherited IRA must be fully distributed by December 31st of the 10th year following the year of the original account holder's death. 10 years. That's it. The clock starts ticking the moment you die. And here's where it gets significantly worse. Because the IRS issued final regulations in July 2024 that clarified something financial planners had been arguing about for 4 years. If the original account holder was already past their required beginning date when they died, meaning they were already taking required minimum distributions, the beneficiary must also take annual required minimum distributions in years 1 through 9 and then empty whatever remains by year 10. That clarification slammed the door shut on the clever strategy where some advisors were telling their clients to just let the inherited account sit untouched for 9 years and then pull it all out in year 10. Can't do that anymore. The annual required minimum distribution requirement is back for most beneficiaries. The IRS wants their bite every single year. Now let's perform the math with calculator in hand. This is the math your broker did not show you at the annual review meeting. Mary, age 76, widowed, lives in Florida. She passes away in March 2027, leaving a $400,000 traditional IRA to her son David. David is 46 years old. He's a mid-career marketing director earning $140,000 base salary, with about $20,000 in annual bonuses. His wife earns $85,000 as a school principal. Their combined household income before this inheritance lands is approximately $245,000 in 2027. That puts them comfortably in the 24% federal tax bracket as married filing jointly, with their top dollars brushing the bottom edge of the 32% bracket. Now David inherits the IRA. The 10-year rule kicks in. Mary was past her required minimum distribution date, so David must take annual distributions starting in 2028. Let's use the simplest version for illustration purposes, an even tenth each year, which equals $40,000 per year for 10 straight years. Watch what happens to David's tax situation. David's household income goes from $245,000 to $285,000 the moment that first inherited distribution lands. That $40,000 distribution is not magically taxed at his old comfortable 24% rate. It is taxed at the marginal tax rate that applies to the top of his income stack. The first roughly $38,000 of that distribution gets consumed by the 32% tax bracket. The remaining $2,000 or so spills into the 35% bracket. The federal tax on just that $40,000 distribution comes to approximately $12,800. That is a 32% effective hit on the inherited money alone. But we're not done with the damage calculation. David lives in California now because he moved for the marketing job promotion. California taxes that $40,000 distribution at 9.3% as marginal income added to his existing state tax calculation. Another $3,720 vaporized to Sacramento. We are now at $16,520 in combined federal and state tax on a $40,000 distribution. That is a 41% combined effective tax rate on the inheritance. David repeats this exact same process every year for 10 consecutive years. Cumulative tax extracted from Mary's $400,000 IRA over the 10-year forced liquidation window, approximately $165,200. Mary thought she was leaving David $400,000. The IRS and the state of California are walking away with the equivalent of a paid-off house in cash. David is netting roughly $234,800 before we even discuss the loss of various phase-out credits, the potential impact on his children's college financial aid calculations, and the possible Medicare surcharge implications if this pushes other family tax planning off track. Now, do something for yourself right now. Pull up your latest 401k or IRA statement. Look at the balance. Multiply that number by 0.4. Whatever number you get, that is what the IRS has currently penciled in as their projected share of your legacy under the existing rules if you do nothing to change the trajectory. The first villain layer is the death of the stretch IRA, which we just covered. That's the obvious layer. That's the layer your accountant might have mentioned in passing in 2020 or 2021. Layer 1 alone is enough to cost a typical middle-class retiree's family between $100,000 and $200,000 in unnecessary taxation. But Layer 1 is just the appetizer. Layer 2 is what tax professionals call the income collision, and this is the layer that should make you pour yourself a strong drink and sit down. The income collision is the brutal mathematical reality that inherited IRA distributions do not arrive in a vacuum. They arrive on top of your adult child's peak earning years. Look at the demographic profile of who inherits IRAs in America. The average IRA owner dies somewhere between age 78 and 84. Their children, statistically, are between ages 45 and 55 when the inheritance lands. Now, ask yourself a simple question. What is the highest earning decade of a typical American professional's life? Ages 45 to 55. That is the decade when the promotions finally land, when the equity compensation vests, when the second income spouse hits their stride, when peak career stage bonuses pay out, when consulting side income peaks, when rental property income starts flowing. The IRS did not pick the 10-year forced distribution rule by accident. They picked it because they have actuarial tables. They know with statistical precision exactly when your children will be earning the most income. They deliberately timed the forced distribution window to land directly on top of the bracket peak. That is not an accident of legislative drafting. That is an engineered feature of the law. Look at the bracket math they use to trap your children. The 12% bracket for married joint filers in 2026 ends around $26,700 of taxable income. The 22% bracket runs from there up to about $94,600. The 24% bracket extends to roughly $201,050. The 32% bracket then leaps to roughly $383,900. If your child is sitting at $190,000 of household income, comfortably in the 24% zone, and you drop a $50,000 annual inherited IRA distribution onto their tax return, you have just shoved them deep into 32% territory and possibly nicked the bottom edge of the 35% bracket, depending on their deductions and credits. You did not give them a gift. You gave them a bracket promotion, courtesy of the IRS, compliments of your 40 years of disciplined saving. Layer 3 is the legislative future, and this is where careful distinction matters. Recent legislation made many tax brackets effectively permanent, or at least extended. That is true, but permanent in Washington has the shelf life of a banana on a radiator in August. Permanent means until the next administration decides to fund a war, a stimulus package, or a pet infrastructure project. The structural pressure on the federal budget over the next decade is enormous. We are running deficits that would have caused riots in the streets in 1985. The Treasury Department must find revenue somewhere. Treasury looks at the projected $35 trillion to $40 trillion sitting in tax-deferred retirement accounts owned by Americans over age 60. And Treasury sees a piggy bank with a glass front and a small hammer hanging next to it. Anyone who tells you with a straight face that tax rates 10 years from now will be lower than they are today is selling you something. Probably an annuity with a 6.5% commission baked into the surrender charge structure. Now let's talk about the surgical strategy, because diagnosing the cancer is only half the job. The other half is the operation. There are 3 specific account types you must drain, convert, or reposition before you pass away. Notice the language, not spend, drain. Drain means moving the dollars out of the tax-deferred wrapper and into a more favorable tax wrapper, even if you do not personally consume those dollars during your lifetime. The 3 account types are these. Account number 1, the traditional IRA. This is the headline villain. This is the account most retirees have the most money sitting in because it absorbed all the 401k rollovers from previous employers over a 30 or 40-year career. The traditional IRA is a tax time bomb wearing a tuxedo and a smile. Every single dollar inside that account is fully taxable to the beneficiary at their ordinary income tax rate. Not capital gains rate, not qualified dividend rate, ordinary income. The worst, highest, most painful tax category in the entire tax code. The fix is called the Roth conversion ladder. You systematically convert chunks of the traditional IRA into a Roth IRA each year, paying the tax now at your current retired and lower tax bracket rate in exchange for the Roth IRA's promise of completely tax-free distributions to your heirs forever. Here is the math on Margaret's situation. Margaret has $1.1 million in her traditional IRA. She's 68 years old. Her annual income from Social Security and a small pension is $58,000. She files as single. In 2026, the 12% federal bracket runs from roughly $11,925 to $48,475 of taxable income. The 22% bracket runs from there to $103,350. Margaret has roughly $45,000 of available room inside the 22% bracket before her income would tip into the 24% zone. She also benefits from the senior bonus deduction, if applicable, stacked on top of her standard deduction. That gives her even more breathing room in the calculation. So she executes a Roth conversion of $45,000 per year for the next 10 years. Every dollar of that conversion is taxed at 22% or less. She pays roughly $9,900 in federal tax per conversion, or $99,000 in cumulative federal tax over 10 years. In exchange, she has successfully converted $450,000 of traditional IRA money into a Roth IRA, which now grows completely tax-free, distributes tax-free to her heirs upon inheritance, and is not subject to the same crushing 10-year forced distribution at marginal income rates that destroyed David's inheritance in the earlier example. Now compare that outcome to what would have happened if Margaret had done nothing. If David inherits a $450,000 chunk of traditional IRA sitting on top of his $245,000 household income and gets forced to distribute it across 10 years at 32% to 35% federal tax rates plus 9.3% California state tax, his cumulative tax hit on that same $450,000 is closer to $175,000 to $190,000 in total taxation. Margaret paid $99,000 in conversion tax during her lifetime to save her family roughly $80,000 to $90,000 in future taxation. But the real win is bigger than that. The Roth IRA she leaves to David comes to him completely tax-free. He has 10 years to let it continue growing before emptying it under the 10-year rule, but he is not taxed on a single dollar of the growth or the distributions. The tax savings are real. The savings are massive. The savings are sitting on the table right now, waiting for you to pick them up with one simple decision. Account number 2, the non-qualified annuity. This one is a stealth assassin that nobody talks about. Your financial planner, who probably sold you the annuity 15 years ago, definitely does not want to talk about this part. Non-qualified annuities, the ones you bought with after-tax dollars outside of an IRA, do not get a step up in cost basis at death. That is the critical killing blow. Let me repeat that because it is so important. Non-qualified annuities do not receive the IRC Section 1014 step-up in basis that applies to most other appreciated assets, like stocks, bonds, real estate, and mutual funds held in taxable accounts. When you die, the gain inside that annuity, which is the difference between what you paid in premiums and what it is currently worth, is passed to your beneficiary as something called income in respect of a decedent, and it is fully taxable to them at ordinary income rates. The wrapper that protected you from current taxation during your life becomes a coffin for your heirs at your death. The fix is to start systematically withdrawing from the non-qualified annuity during your lifetime, ideally using the LIFO rules to your advantage if it is a post-1982 contract, or executing a 1035 tax-free exchange into a more favorable structure. There are also charitable strategies available. There are spousal continuation options if you are married. There are even partial annuitization tactics that can help. The key concept is this: do not leave a non-qualified annuity sitting full of accumulated gain at the moment of your death. That is a gift to the IRS with a big red bow on top. Account number 3, the 403B and similar tax-deferred employer plans, including 457B plans for government and nonprofit workers, and older 401k accounts that you never rolled over into an IRA. These accounts have all the same tax problems as the traditional IRA, plus a few additional landmines. Some 403B plans have terrible distribution options that do not allow for flexible inherited account structures. Some have surrender charges if you move the money in the first few years after retirement. Some are tied to insurance company products with hidden expense ratios that compound the damage every year. The fix is to roll these into a traditional IRA at retirement, primarily so you can then execute the Roth conversion ladder strategy just described, but also to gain complete control over the beneficiary designation rules and the distribution flexibility. Consolidate the accounts first, then convert them second. Two-step process. Now here is the sequence that matters, because timing is more important than almost anything else in this entire game. Year 1 of retirement. typically age 63 to 67, before Social Security starts and before required minimum distributions kick in. This is your golden window. Your taxable income is artificially low. You are not yet pulling Social Security if you delayed claiming. You are not yet forced into required minimum distributions. Your tax bracket is the lowest it will ever be for the rest of your life. This is the year you run your largest Roth conversions. Fill the entire 12% bracket. Fill a substantial part of the 22% bracket. Stop before you trigger Medicare IRMA surcharges if you are within 2 years of turning 65. Document everything with your tax preparer. Years 2 through 5 of retirement. Continue the Roth conversion ladder. Watch the IRMA thresholds like a hawk, because every dollar over the IRMA cliff costs you hundreds of dollars in additional Medicare Part B and Part D premiums 2 years later. Coordinate conversions carefully with Social Security claiming decisions. If you are married, time conversions to use both spouses' tax brackets while you are both alive, because the surviving spouse will jump to single filer tax brackets the year after the first spouse passes, and those single filer brackets are significantly more brutal than married filing jointly brackets. Year 6 and onward, once required minimum distributions begin at age 73 under current law, the Roth conversion math gets harder because your baseline taxable income just jumped automatically. But this is also when qualified charitable distributions become available at age 70 and a half. Qualified charitable distributions allow you to send up to $108,000 per year in 2026 directly from your IRA to a qualified 501c3 charity. And that distribution counts towards satisfying your required minimum distribution without ever appearing on your tax return as taxable income. If charitable giving is part of your annual plan anyway, the qualified charitable distribution is the single most tax-efficient charitable tool in the entire tax code for anyone over age 70 and a half. And finally, the beneficiary designation review. Pull every single retirement account statement you have. Every IRA, every 401k, every 403b, every annuity, every pension with a beneficiary option. Look at the primary and contingent beneficiary designations on each one. If you have not updated these designations since before 2020, you need to update them immediately. The Post-Secure Act planning landscape fundamentally changed who should be named, how trusts should be drafted as beneficiaries, and whether per stirpus versus per capita language belongs in your designation. A poorly drafted trust named as IRA beneficiary can accidentally accelerate the entire 10-year distribution window into a 5-year window. That is a doubling of the annual tax pain for one sloppy legal document drafted 15 years ago. Fix it now while you can. Here is your final warning and call to action. The window is closing. Every single year you delay running Roth conversions is a year you are voluntarily gifting money back to the IRS that you could have kept in your family. Every year that passes brings your children 1 year closer to inheriting a tax-deferred grenade with the pin already pulled and the timer running. The tools to defuse this bomb exist right now. The tax brackets are still historically low compared to where they will need to go to service the federal debt over the next 20 years. You are sitting in the middle of a tax holiday, and most retirees do not even realize it. The clock is running, the math is clear, the strategy is legal. The only question left is whether you are going to execute it, or whether you are going to let 40 years of disciplined saving get stripped down to 60 cents on the dollar by a tax code written behind closed doors specifically to extract wealth from middle-class retirees who saved responsibly their entire lives. The IRS already knows about your IRA. They already know about your annuity. They are already projecting the revenue from your death in their 10-year budget models. The question is whether you are going to let them collect it or whether you are going to take it back while you still have time. Take it back.